Very good morning to everyone. So, in the first chapter, we have discussed about mutual fund, understanding about mutual fund in various contexts, the types of mutual fund, the objectives of mutual fund. Then we have gone through for the limitations about the investment. When it's come for types of mutual fund, various avenues of investment, how investments are done, and what are the good things where investments are gone getting written, different classification of these investments, really helpful for the investor to know about the objective of their investment. So this what been explained in the first unit. So unit 2 talks about understanding the mutual fund, or understanding the mutual fund investment. Now when we go for understanding mutual fund investment, you should know about the various mutual fund schemes and how these investments are made in various avenue. What are the reason for investing in various avenue, and why these investments are basically is required. Now in this chapter we are going to study about a detailed understanding capacity of investor about mutual fund, and the different investments, types of investment in mutual fund, and their objectives. So coming to the this chapter, we can see here there are different contexts talking about the mutual fund, invest another side, the various risk associated, the various profit or gain associated with the fund, and the life of this fund with the calculation of how written. That's why we have a calculation here of asset management company, how they evaluated the risk, how they evaluate their profit. Now, there is a slide which talks about the basic introduction about understanding of mutual fund, and all need to go through for this link, and you'll get an idea about the basic introduction. So we'll go for the next slide, which talks about the various investment avenue, and how this investment avenue will make profitable for investors. So mutual fund pool money from investor to invest in diversified portfolio of securities. So mutual fund pool money from investor. That's why it is money of many. So mutual funds are also called it's the money of many. So mutual fund pool money from investor to invest in diversified portfolio of securities. There are different types of investments in mutual funds, where different types of investment are really invested in the mutual fund and return expected. But when we talk about mutual fund, the money invested in different mutual fund, and the investors money invested in the mutual fund, they are based on certain assumptions, and they are based on certain objectives. Now we are going to see which are the investment avenues where exactly company can invest, where exactly the investor would like to invest, and which investment is much more better, and how this investments are really is considered in terms of what. So all these are studied in the basic objective of types of investment, and these types of investment based on the fund mobilization, fund utilization, at the same time a risk return profile based on the investment pattern. Now first type of investment which is investment in the mutual fund is stock, and the stock we have already discussed, and we have already studied about the stock, what kind of a various stocks are there, and how it is invested, how risk return profile can be considered. All these are classified under stock. So based on the this classification, you can see here the stock in form of equities. So many people invest in equity, especially the long term. Some might be in care for medium capital investment, for some might be go for small capital funds, some may just stick on for the longer period, because the assumption is like, if I invest now, if I hold the same stock for the next 10 to 25 years, it might really fruitful for me, because I invested for longer period and hold it for longer period. Many people just buy now, and they just wait for one systematic return in a future day. So here first investment pattern, investing in mutual fund in form of stocks. This funds, mutual funds investment in form of stocks. So the purpose of the stocks or equity to generate capital appreciation, growth, and sometime with the dividend. And everyone knows that equity investment in equity 100% it will yield dividend, and this dividend yielded based on the market value. So how dividend face value is fixed on based on the face value dividend declaration, but there is one specific market price too. So you buy in what price, whether you buy in the discount price or you buy at the par value, you buy on the premium price. So when we come for discount, equity is paid with the lesser price whatever market price has been fixed. So market value what they issue, but customer just go for buying under discount value. Then you have a based on the par value which remains same. The market, if 10 rupees is the face value and the market value itself is the 10. But when it's come for discount, 1% discount you got, so 9 rupee is the issue value. When it's come for premium price, always the prices have been added on, so you pay extra price to buy. Why? Because there is a huge demand for such kind of equities. So there are many company who do well, whose profit is more, quarterly income, yield much more revenue generated, and it is a part of the dividend is distributed for the stakeholder, the shareholder. So that is classified. So investment in the mutual fund is classified in different terms and different conditions. So we are talking about the stock equity. Purpose of equity generate capital appreciation, growth, and sometimes in form of dividend. So company also invests in various avenue, might be invest also invest in various avenue. Investors would like to buy a big large capital funds where they can wait for the longer period and they can expect the large return. So here there are types of equity funds. One is the large capital fund, investment in large capital fund established by company and waiting for a longer period. Then there is a mid cap, there is small cap funds focus on a smaller company with a high growth potential. So see, this is the difference where the large capital fund, when it's come for investment in the large capital fund, it classify based on what condition, what assumption. So here people just invest in the large company expecting a high return, and they might be having a slow potential or high potential growth. Even after that people want to buy the capital in the large firm. So mid capital, mid company, small capital focus on smaller company with the higher growth potential. Then you have sectoral fund, investment in specific industry. I have said in the first chapter about some of the investor would like to know about the investment pattern and they invest on specific industry. I can give an example. There are investors who would like to invest in the steel company or manufacturing, automobile industry, or technology based, or the day-to-day routine items which has manufactured. And some people under healthcare, some people go through for cement industry, some might be with the other sector. So there are sectoral funds where a specific industry has been identified and people are more interested to invest in. Then you have a international and global fund. So invest in a company outside the investor home, especially foreign countries. So there are many company who are eagerly waiting to invest in rather than the domestic company or domestic country. They just go for investing. That's why you have FDI, foreign direct investment. People invest, foreigners investing here. We invest outside. So this is the open market where you can go through for a buying of the stocks in form of rupee converted into dollar or in form of any way. So international global fund investment outside rather than domestic market. Next types of investment, you have a bond. Now bond can be fixed under redeemable or redeemable. So normally bonds with the regular income and preserve capital too. So bonds, sometimes government bonds issued by national and local government, corporate bond issued by the company to raise the capital. Especially you have a private company who just go for issuing corporate bonds, where you raise funds in form of debt or equity or any other form, and one form will be the corporate bond. So corporate just go for issuing of corporate bonds. they might be return higher than any other form. So they go for issuing of number of years and getting fixed rate of dividend. So in form bond, you get certain kind of a interest when bonds are being issued. It might be the government bond based on the national and the local government. Corporate bond talks about issued by the company to raise the capital. Municipal bond talks about local government, often tax advantage, especially when it's come for bond, buying the bond, paying of interest, and 100% tax exemption, tax relief. Then high yield bonds offer high return but come with the higher risk. So obviously when it's come for higher return, higher bond, it just go for that which is more interesting, more profitable, which is less profitable, which has the highest risk, which has a less risk. Based on this classification, it is considered a high yield bond will give a certain return along with the high risk. So there are people who want to invest in a high yield bond. They expect with the high profit. The meanwhile, it is understood they face the high risk too. Then you have money market instruments. So when it's come for money market instruments, the purpose of a money market instrument ensure liquidity and safety of principal with modest return. So you have a treasury bills which is issued by the government, then commercial paper by the bank or the industry, corporate sector, certificate of deposits by the banks, and repurchase agreements, repo rates. So if you see in when it's come for money market instrument, there are various avenue where people would like to invest in different avenue, and they see that what is the tenure of investment, how long I can invest to invest in this kind of investment pattern, how return can be expected, what is the mode of risk attached, then what is the prescribed format to invest in this kind of a stocks or bonds or equity, and how these instruments make a much safer compared to rest of, because equity has a highest risk compared to the rest of the instruments. So why? Because rest might be with the fixed rate of return, but we always classify where you have a high risk and high profit. Compared to that, you don't have to stick with one particular investment. You can diversify this investment pattern. So there are many investment pattern in the mutual fund which is diversified. In one side you have a less risk, might be high return, another side you have a high risk less return, or sometimes high risk high return. Based on this classification, people just go for investing. So you'll study in very detail when it's come for practical term. So money market instrument where is one of the pattern of investment. So purpose ensure liquidity, safety of principal with a modest return. That is the main purpose. Here you have a treasury bills, commercial paper, certificate of deposit, and repurchase agreements. Then fourth one, you have a real estate investment trust. Purpose will be offer exposure to real estate market without direct property of ownership. Mutual funds may invest in real estate investment trust or real estate related security for income and diversification. When we talks about real estate, the real estate return is not expected in the short term. Why? Because it depends whether the places like how these investments are diversified. When it's come for real estate, what are the pros and cons of this real estate investment trust? Like your waiting period, it is similar kind of investment you do in the market, buying of equity or any kind of instruments. But in equity, there might be chances of if market is good, then your return can be expected. Market is bad, return can decline too. But when it's come for real estate, whatever you pay for the land or the property, the building, which is not movable, 100% return can be expected within the period of time. Might be you hold for 6 months or 1 year or more than 1 year, but minimum expectation return can be expected from the real estate. Why? Because real estate is one type of investment which will yield a definite a minimum percentage of return without any type of risk. So real estate trusts maintain this kind of investment pattern. You might be seeing that investments are made on real estate and future expectation without any type of risk. Some people might hold for 1 year of one property and might sell for in future if there is a good rate. So real estate is sometimes it go with the location wise also faster growth and faster return without less risk. So purpose offer exposure to real estate market without direct property ownership. Then fifth one, you have a commodity market. So purpose hedging against inflation, diversity, the portfolio. So hedging, right? People just go for hedging in form of mortgage. You hedge the property, you hedge the movable or immovable properties. So here, hedge against inflation or diversifying the portfolio. So you keep your property or your asset whenever there is a market in high rate, high demanded or diversify portfolio. You just go for keeping mortgage of the assets. So the some of the mutual fund investment in commodity like gold, silver, oil, agriculture products, either directly or through the derivatives. So there are people just go for hedging against inflation. There are people they go for diversifying of different portfolio. Some might retain same, some might invest with the diversification, some might invest more and more based on the inflation rate. So this is what the example is all about. Now uh, the first understanding mutual fund, different types of investment and where it is been invested. You've gone through for the 5 points here. There are remaining points that will be explained in the future classes. I have sent you one link and shared in this PPT itself. All need to go through for this link and just go for understanding mutual fund and how to understand this mutual fund when it's come for investments. So how these mutual funds have been invested in various tasks. So all go through for that link, especially have been posted here and it will be posted in the group itself. So go through for understanding and go through for the first talk which is assigned to you. So thank you all. Remaining class we'll see in the upcoming class.